Hello, everybody around the world. Welcome to Quick Start Lab number 8. You guys have done such a good job. I mean, Corey and I were just speaking before we went on the air here, just how much we've enjoyed this particular group. You guys have worked hard. You've been very positive, interactive. It's just been fantastic to be with you. So we thank you for that, and it's going to be awesome. Let's begin as we should, with a quick note on risk. That's a huge note on risk. Holy cow. That's a little bit better size. Just a reminder, everyone, that this is about education. It's not about giving out fish. It's about helping people learn how to fish, for sure. And so that's an important thing. And even though the trades we've done in this particular Quick Start Lab have all worked out, doesn't mean there isn't risk, and we don't imply that they'll work or not work. You guys know the numbers. There's a percentage that it'll work and a percentage that it won't work, and both are there. So we don't know which one it's going to be ever. That's why we have the fourth pillar of risk management. It always involves risk. So with that, we welcome you guys. And let me bring up, let me get myself organized here on my other screen. First thing after the disclaimers, if you can hear me, raise your hand so I know I'm not talking to myself. Let's see. There you go. Carly Morris had her hand up first. Look at that. Brett's got his hand up, and Bettina, and applecrisp@mac.com. What a great email that is. I love Applecrisp. That's fantastic. Aiden's with us. Andrea, everyone. I can't scroll through all. There's so many people. It's awesome. But you guys have just done a great job, and this is not an ending. This is a beginning. We're going to show you some more trades. Also, congratulations. We had a lot of you showing interest in Ultimate Options, where you want to go further with this. And we ended last session by saying, okay, do you guys want to just do Q&A, or do you want a lesson? And a whole bunch of you said, well, why not both? And I thought, well, why not both? So we're going to do another trade, a cash flow trade. One of my favorites. So we'll have a lot of fun with that, and then we will also do a little Q&A with you guys, and it should be a lot of fun. So that'll be awesome. So here we go. Check this out. Let's look at things this way. If we have our personal fundamental analysis right here, and you guys have been through 4 pillars, and I think one of the life-changing things that anyone can learn to do is come up with 8 numbers. Cash flow, net worth. It's, you really need to make a distinction between cash flow and net income, because they're not the same thing, but we'll cheat a little bit here and call it the same thing. So you have income, expenses, assets, liabilities, cash flow, net worth. You have your credit score, and you have your buying power. And if I were, if you were to invite me over and say, hey, let's put something on the grill and cook it and eat it and get away from social distancing and just enjoy each other, and maybe we go, over to your house and out back by your pool or whatever, and we sit back there and we got something on the grill, and they say, Andy, if you only had 10 minutes to share financial education, where would you start? This is where I would start with people. I like that idea, Kevin. We'll do that out on the balcony. I like that. And so, Emmer, it doesn't take much to get me to San Diego. My buddy Than Merrill's down there, and I'll go to San Diego any day, baby. That climate's fantastic. Great diversity of people. It's a wonderful place. That we fill out where you're at. We fill out where you're at, and we say, look, if you don't have assets, then we probably need to increase our buying power. This is usually if a person's starting out at square one, and they have nothing. Let's say someone comes, they immigrate to a country and they're starting out with nothing. You increase your buying power, right? And expand your ability to buy assets. And as you buy assets, you want the assets to produce income, right? And hopefully that income raises your cash flow, and the assets go up, your net worth goes up. You find a lot of great prosperity here. And so when you buy assets, one of the questions we want to be able to do is to do a lot with a little. We want to be able to do a lot with a little. So if I have a lever, and here I am, with my hands on the lever here. Apparently I have no neck now and a long torso. But if I have a lever here, right, I can lift something very heavy. I can lift a lot with a little effort if I have a lever. And your leverage has a lot to do with your initial investment. So I'm going to show you something here. We can play with this. We can play with this. So let's say I sell a call, right? I sell a call, and that call is $1 premium. I can sell that naked and just get the dollar, right? I can just say, hey, I make a promise and get $1. So that's on one end of the spectrum. What I could do also is I could do maybe a bear call, and you guys have learned this trade. Maybe I do a bear call spread where I sell the call. Whoa, wow, that's never happened to me before.
And you get an island. You sell
enough
of those
sell
calls.
A call. You buy Catalina Island right there. Yeah, you just take Catalina Island and stick it in your back pocket, which means you sell the call for $1, and you maybe buy a call for 50 cents, and you make 50 cents on $5. So here you just get the money. Here you get half the money and 50 cents of risk. So that's pretty good. This 10% return, right? That's 10% return in a month, right? Or maybe you do a covered call. And to get that same dollar, you spend $50 on the stock, right? You buy the stock, you do a covered call like we did last week, and you spend $50 on the stock, and then you sell a call, and you get that dollar, which would be what is that? 2% on your money?
Yep, 2%.
So your percentage, gets higher depending on what underlying asset you have, right? Or maybe what you do is you buy it. We can go back even further this side. Let's do it this way. Let's take a picture of this. Maybe you could even go back even further. Let's see. And you can create this spectrum, right? You can create this spectrum of leverage is really what I'm doing right here. So let's bring this over and get rid of this ink. And I'll put this over here. And maybe even here, we could say, what I'll do here is I'll buy the stock. And I'll just buy the stock. And I'll collect the dividend. And maybe the dividend is 6% divided by 12 months as I get 0.5% on my money for the month. So here I'm making 0.5% on my money for the month. Here I'm making 2% for the month. Here I'm making 10% for the month. And here I have an infinite return because I had no underlying asset. I just made a promise. And this is where insurance companies live. Of course, they have a little cash to back up their promise, so that's maybe not necessarily true. But still, it's pretty, you understand the basic idea. So there's so many different ways to take advantage of, here I'd want the stock to go down. Here I'd want the stock to go down. Here I'd want the stock to go sideways, maybe up a little. Here I'd like the stock to go up. And depending on what direction you think it's going to go, you could choose one of these. So to start out here just with a yes, does everybody see how my return on my investment is different depending on what strategy I want to use? Just give me a little yes if that's pretty clear. Okay, pretty fun stuff. You guys are awesome. Fantastic. So what we're going to do today is I'm going to show you how to do this and get more money out of it, which is very conservative, without having to do this, which is very, very aggressive. So we're gonna have some fun with this. This is a really cool way to do it. So let's start off with a little lesson right here. When I sell a call, let's just use a call option or a put. Really, what I'm doing when I sell a call, what do these people get? In other words, I've showed you I showed you a picture in my office of Warren Buffett says, be greedy when people are fearful, be fearful when people are greedy. Well, I didn't show you the other one I have right next to the one on there. It says this, and it's by Charlie Munger, who is Warren Buffett's partner. And I actually have this one in order before you get to Buffett. This is the first one I have. It says this: if all you succeed in doing in life is getting rich by buying little pieces of paper, it's a failed life. Life is more than being shrewd in wealth accumulation. I love that quote. I'll say it again. If all you succeed in doing in life is getting rich by buying these little pieces of paper, it's a failed life. Life is more than being shrewd in wealth accumulation. And the reason I love that quote so much is, I'll tell you a little story. I had a group, a very large group, it's a multi-billion-dollar company, approached me. And they said, hey, we like the way you teach. We'd like to do business with you. And initially I said, well, I'm honored. You're always honored if someone wants to do business with you. And as we got meeting and went down the road a little bit, I broke it off. I said, you know what? I'm not comfortable with you guys' basic philosophy, because everything they ever did in their marketing was about getting rich by buying little pieces of paper. And it was interesting because nowhere in any of their marketing or nowhere in any of the messages they put out was about giving value to people. And I believe that you can have a really good long-term business if the people you serve are truly being served and they get value for the money they spend. So one of the most important things in this last Quick Start Lab that I think I could leave you with is an understanding that we're not just shrewdly moving pieces of paper around here. My question is, when you sell a call to someone, what value are you getting? Because think about this right here. Here's you, and here is your customer, in a way, and they're sending you cash called a premium. They're sending you cash called a premium. Now, anywhere I go in the world, when you have a person receiving money, right, customer, there's some type of value that goes this way. So we don't want to just be, let's see, value. I don't know if that's how you spell value or not, but there's some type of value that goes this way. So my question is, when you sell a call and collect the premium, what is it that you're giving them as opposed to just receiving money by shrewdly moving around pieces of paper? Is there any value right there? Ooh, Kevin, I love yours. Yeah, you're giving them a choice. You're giving them security. You're giving them insurance. You're giving them options, right? You're giving them a choice to do something. And generally, watch this, what you're doing is you're giving them a value, and you're also giving them time, a certain amount of time. So you're giving them value over a certain amount of time. Does that make sense to everybody? And time is money. One of the great things that you can give to your children is your time, or your nieces, or your nephews, or your spouse. In fact, the whole cockeyed reason is if all you do is get rich in life by selling little pieces of paper, it's a failed life. Notice what he said. If all you succeed in doing in life is getting rich by buying a little piece of paper, it's a failed life. Life is more than being shrewd in wealth accumulation. So I need to ask myself, well, Andy, is there anything else you've gotten good at other than teaching people, how to do options and stuff like that? Is there things you've done? Well, I'm a basketball coach, and I'm blessed to have the time to do that. And, for years and years and years, since my kids were in the third grade, after school, I get to be with them and their friends for an hour and a half and, coach a game that we all love and get to know their buddies. And, hopefully my wife still likes me. We've been married 27 years, and she says, but it feels like 27 minutes underwater. But she's hung around, and, I've got good friends like Corey and you guys, and, we'll become better friends as time goes on. And, that's more about what life is, right? That's more what life is. So understanding, giving value is a huge thing, and giving people your time is a huge blessing for many people. If you can give them your time. I got my window open because it rained this morning and it's beautiful, and I should have shut it because a truck drove by, which is weird because I live on a private lane and we usually don't have trucks go by, so that's weird. Someone must be having something delivered. So the value is the time. Now watch this. So let's just take this time component and separate it out, and you can learn a very cool lesson. Think about this for a minute. If you have a house that you rent, so you're the landlord, landlord, that's not two words, but we'll put it two here. And here I have a tenant who is also a customer, right? You could call them a customer. What am I giving them? Well, I'm not giving them the house because the house belongs to me. I'm giving them what? Giving them time to let that I'm letting that house out for time. I'm renting that house out for time. Insurance is about time. Usually when you buy insurance, there's a time element to this. So does everybody understand that one of the things we're giving people is time? You follow that? It's time. It's a promise that lasts for a certain amount of time. This is pretty good. Christopher says, you should be a swimming coach. I should, because I can touch the bottom anywhere in the pool, man. I'm 6'8". I can touch that bottom. So watch this right here. Now watch. So we're selling something. We're not just, moving around a piece of paper. We're selling something. And when you sell something, you can do, what you want to do is you can buy at wholesale. You can buy at wholesale, and then you sell at retail. See that? Buy at wholesale and sell at retail. So let's make a great big bucket. This is very important here. This is a great big bucket of ice cream, which, is my favorite dessert. And maybe we buy this, let's say, for $50. Let's just say that, for $50 at wholesale. But then what we do is we sell an ice cream cone for $3.50 at retail. Does everybody understand that? Is we buy at wholesale in bulk, right? In volume, we buy a whole bunch of it, and then we sell this over time. So maybe this would last me, for maybe a week, right? But this ice cream cone lasts for, 20 minutes. Look at that. A week, 20 minutes. So I'm buying a whole bunch of time at wholesale in order to sell 20 minutes of time at retail. Does everybody understand that pretty well? Yes? Just give me a yes if you say, hey, that's it. Sean says, that's expensive ice cream. Well, let me tell you, I don't go for that no-name stuff, man. We got to get the, the Baskin Robbins stuff. We got to go to Cold Stone, right? Go to Cold Stone. So this is a business, right? This is a total business, right? Someone says, not in LA. That's cheap in LA. Retail for the win, right? Retail for the win. And so that's how this works. So watch what we could do here. This would be interesting. Let's look at a couple different scenarios right here. Well, let's undo that. We won't want two lines up there. We want good lines. Okay, let's look at three different scenarios right here. Let's say that I want to be covered. Well, in order to be covered, that means I must be able to keep my promise. I have to be able to keep my promise. Okay? And so right here, if I bring in the premium in my income column, I would probably want to own some stock. Because what is a call? Well, a call is a promise to sell stock, isn't it? If I sell a call, like you guys said, I promise to sell my stock anytime over maybe the next 30 days or something like that. So the problem is stock is expensive. So let's look at Microsoft for a minute. Okay, let's look at Microsoft for a minute. So Microsoft is trading at about $175, let's call it, $175. So for 100 shares, in order to do this, I'm going to have to spend $17,000 to get 100 shares of stock to be able to make a promise to sell 100 shares of stock. And let's just look at what the premiums are. Corey's being patient. He's like, Andy, I could have taught this in like 2 minutes.
No way. This is perfect.
Okay. And so we look at Microsoft and we say, look, we've already got something in Microsoft, so I have to get rid of the stuff we have already. There we go, and do something new with it. And so we look at Microsoft, say, well, how much would that cost us, right? What exactly would that be? Maybe it's for a month, May 15th. And we look at it where it is right now at $175. Whoop, I went a little too fast right there. $175. This is wonderful. Maybe I ought to give myself a little bit more real estate to look at things like that. So Microsoft's sitting here at about $175. And
something seems off on those.
Something's weird because I'm not getting in the money and out of the money for some reason. Have you noticed that?
Yeah, and those quotes can't be right. They wouldn't be paying you $170 for an option when the stock's at $170.
There's something wrong with that for sure. Let's look at a different month maybe. I've never seen anything like that. Have you?
No, it looks like
here we don't even have any.
These quotes are wacky.
There's something wrong with their paper trade system. Let's try a different stock.
Yeah, I was going to say.
Let's do. Should we do Amazon since that's ridiculously expensive?
You could do Tesla. Apple or something, which would be a similar price point.
Apple's like $300. Yeah, Apple's $284. Let's see what they say.
A little closer than
look at those.
Amazon.
Look at those.
Yeah, those are off too.
I'm going to log out and log back in. Hang on, I got an idea. Hang on, I'm going to log out and log back in. Just be patient with me for a minute. That's in all my time I've done this, I've never seen that happen. And what I'm guessing is maybe they've directed resources. So I'm going to open up a small. I have like tons of accounts, so I'm going to open up a live account instead of a paper trading account. Now we're going into a live account, people. So don't freak out here. You guys never do this. We always do paper trading, but I'm going to go into a live account. I think I have one that's kind of empty. Let's see if this one will work. Pillars, and we're going to go here. That's really interesting. I've never seen the paper account messed up like that.
And that's one of the unfortunate things. On occasion, I'll have people say, this is what's happening in my paper account, and it'll be, some weird thing like that. And you just have to be kind of patient with it because these brokers don't put time and resources into a practice trading account. They just don't really care about them from the standpoint of there's no revenue, there's nothing like that. So it definitely doesn't. Paper platforms don't work as well as the real thing. That's for sure.
Let's see if this one will work a little better. This is not a paper trade account. This is a real account. And boy, that looks a little bit better to me, doesn't it to you?
Yep, now we're getting some good quotes.
So they're saying, look, we're not going to spend time to fix the paper trade account, but we will fix the real one right here. So let's get us a bunch of strikes. And doesn't that look much better? I've got some in the monies and some out the monies. Corey, that looks a lot better. So Perfect. Let's say I buy the stock at 175, and let's say I want to sell like a call that's like, I don't know, 195. That's fair enough for you? We'll just call it, let's try and let's do this one. Let's go at 190 and try to get $3 even out of it. That way the math will be easy. Everybody okay with that? So here I have 100 shares of stock that cost me $17,000. I'm going to try and get $300 in premium out of it. Now let's look at the math on this, because the math on this actually is going to be pretty good. So $300 divided by $17,000 is 1.7% for the month times 12 months. That's a 21% annualized return. So I'm pretty happy with that. But here's the challenge with something like this is not everyone is my age. We've probably got people listening that are in their 20s. And Corey, if you'd have asked me when I was like 25 years old to come up with $70,000, dude, it just as well been 10 million. I mean, it wouldn't have mattered, right? And so someone's going to say, well, how can I do this? Now, the other thing we could do is we could just go naked, and I don't know if that would be the favorite thing to do. It's just, we have some money in our account here, but we don't really own anything to cover it. And we make that $300 and we're doing a naked call. And that's like the most risky thing you can do because this thing could go up and then you'd be in trouble. And let's say, Microsoft goes to, $200, $300, $400 a share they invent some amazing thing and now you're on the hook. So it's kind of like the story of Goldilocks and the Three Bears. This porridge is too hot and this porridge is too cold. Maybe we can find some that's just right. So think about this. What are we really selling? We're selling time. So watch this. What if we did this? What if we said, how can I still be covered? We'll call this the poor man or woman's covered call, right? How could I still be covered but not have to spend $17,000 for the stock? Well, I'll show you a way we might be able to do this. Let's take a picture of this so we can have it. Probably not the best picture in the world, but it's going to do for our purposes just nicely. So take a picture of that. That wasn't a complete good picture. If we're going to take a picture, let's do it right. There, that's a good picture. And we'll just take a picture of that, and we'll put it right where we can have it here. Let's move this giant picture over here. Somehow it got made very, very big. And we'll just keep this over here for the time being, right? We'll just keep it over here and say, what can we do? Well, what do we need to do to be able to keep our promise? Well, one way to keep our promise is to have the stock. But another way would be to have a long option. So watch this. Let's go out for May. And should we do a long one, Corey? What do you think? Should we do it January?
We could go out January
22 or 21?
Or, something like that.
Go out. That's good. Next January is good. Do you like that?
Sure.
So let's go out to next January and look. We can buy ourselves a call for about $20. And what's the mark on that? The last was, let's just get a mark.
2020.
Yeah, let's get a mark.
Mark's going to be right in the middle there, probably.
So the mark's going to be 2027. So we'll call it 2020. So check this out. What if we, in our financial statement, this is called a long-term equity anticipation security. And long-term equity anticipation securities are further out. Actually, this is not quite one. It's not. They're usually 8 months or more. But basically, it's a long-term thing. And let's say we buy the choice, because we're buying a call, we buy the choice to buy Microsoft at 175. Well, what's the difference? I mean, if I own it at 175 or if I could own it at 175 if I wanted to. I'll tell you what the difference is. This is $17,000 to get it done, right? This is going to be $2,000 to get it done. Why? Well, look at it. It's only going to be $20 so $2,200 is what it's going to be. It's going to be 2,000 or no, it's going to be what? 2020. It's going to be less than that. So about $2,000. It's going to be 2020. Hey, that's kind of coincidence. It's going to be 2020.
Nice.
So that's a huge difference. Now, if you'd asked me for $17,000 when I was 25, I said, well, you're smoking Colorado grade marijuana. I'll have that. But you know what? I come up with $2,000 when I was 25. I could do that. That's doable for me. So now what I'm doing is notice that I'm buying a nice big bucket of time Look at this. This is no different than ice cream. Look at this. I'm buying this nice big bucket of time where I can do this anytime for January. And now I can sell this same call, right? I can sell the same call for 1 month, right? That's my little that's a big ice cream cone. I can sell that same call now, and look what that does to my return on investment. Is now what I can do, let's get rid of that. Now what I can do is I can say, well, now I can make that same $300 for selling the call in not January, but in May.
In May. Yep.
I can sell that May call. So let's just put that down in big red ink here. I can sell this May covered call at, what was the strike price, Corey? It was
$290, I think.
190.
190. 190.
Or yeah, 190. I can still get that $3, so it's gone down a little bit since we've been talking. But I can sell that 190 call in May, and I'll show you something that's pretty cool here. Let's keep this in a picture as well, because this is worth taking a picture of. This is worth taking a picture of. I think you guys are going to like this. Yeah, for sure. You're going to like this. So now, get rid of my ink. So now I got this idea here of selling this call, and I can do it for much less. So 300 divided by $2,020, that's 14% on my money for the month. Now watch how cool this is. Watch how cool this is. If you guys remember, I've drawn a couple of these for you guys. Is we have January of 21, right? Then we'd have December of 20, and November of 20, and October of 20, and September of 20, and August of 20. 1, 2, 3, 4, 5, 6. This might be a leap. July, it is a leap of 20. June, May, and April of 20. Look at that. So I'm going to take a picture of this. In other words, we've got quite a bit of time that we've bought here in our January leaps that we've bought. This January leaps that we've purchased. So we're going to take a picture of that so we can size it up nicely. This is just going to be lovely right here. So I have all this time right here, right? All this time. Let's bring this over, and let's make it a little bit smaller. And now watch what I can do. I can say, I can draw my graph right here like this, and the price of this was $2,020 to buy this, right? Now, what is the time decay graph going to look like? It's going to look like something like this. See this? And so watch. If I go from May to April, that's a little tiny bit of time decay right there. Little tiny bit. And I'm not going to time decay very, very much. I'm going to time decay very slowly. Now, from December to January, that's a huge amount of time decay. And just give me a quick yes or no. How many remember this lesson either from the 4 pillars or for Quick Start Lab on time decay? You guys remember this? I got exclamation points. Anno gave me an explanation. This is, yes, I remember this. Oh, who wrote down milk? Eric wrote down, this is just like the, yeah, you guys got it. This is just like the milk. That's right, this is just like the milk. So what I'm doing is I'm buying milk that doesn't expire till January 21st, but I'm selling milk that expires quickly. So what's cool is watch this. The milk that I'm buying only decayed this much, but watch what? The milk that I'm selling decays that much. You follow that? So I'm getting a lot of decay on this ice cream because I got to eat that in 20 minutes, but this tub of ice cream is going to last me till January. And so before we've called these like bear call spreads because we're getting the spread between two, right? Or bull, we have like a bull put spread or bear call spread. This is called a calendar. I don't know how to spell calendar. I think that's close. This is called...
Nailed it.
Did I get one right? This might be a record of spelling calendar correctly. First time ever I've got it right. And so this is called a calendar spread, where I'm not so much making money for the spread vertically. I'm actually making money diagonally, because what I have here, and I'm going to give you just a quick lesson on this. Let's save all these cool drawings that we've done. Let's save all these cool drawings that we've done and bring this over here like this and get rid of that ink. Go ahead.
And I was just going to point out that in terms of this trade, if you look at it as far as the quantity of time is concerned, it'll even show the dates. Like May is only 29 days, where January 2020 is going to be 270 or whatever it was. 274 days. So that's the differential there. We're selling a little sliver there, and it'll actually give you the number of days until that expiration. So you can really kind of quantify, well, how many of these could I sell? If I have 274 days and I sold a roughly 29-day option, I could do about 9, almost 10 of those in terms of premium. Yep. Before I'm done. So just in the premium that we collect. And this trade, we're going to talk about calendars. There's also another name for it, which is diagonals. And they're kind of the same. They're in the same ballpark.
I'm going to take them through that, because let's say that we have the month of May coming up here, and we bought at 175, and we're going to sell the 190s. In the same month, okay? So this right here is vertical. See that? Now let's say we go out to January of 2021 and we have a 175. So if I bought these and sold these, that would be what we call a horizon, or a level here. A horizontal spread, because we're giving the same strike price of 175. We're buying and selling the same strike price, but we're out in time, so it's horizontal. Okay, now let's look at that 190 right here. So if we buy this one and sell this one, right? If we buy here and sell here, which is what we did, which is exactly what we did, well, what's this going to be? Well, we have a vertical component because we're going from 175 up to 190, and we have a horizontal component because we're going in time. So guess what this is called? This is called a diagonal. You
didn't nail that one.
I did not nail that one. Diag. You know, what's fun about my inability to spell and think is, hopefully all these students that are watching, they're like, I just have a tremendous amount of hope for myself, because Andy's a complete moron. And if Andy can teach this stuff, certainly I can learn it. James Cole.
We could all tell it said diagonal, so no worries.
Yeah, James Cole says diagonal. Kevin George, can I just tell you that a lot of people get dopamine hits for different reasons, okay? And I will tell you the reason that, I'm going to take a picture of what Kevin said right here, because what I just absolutely love, well, look, we've actually got 2 comments in here that I like. Bonus. This is why I love doing this, is Kevin George says, this is a light bulb moment for me. The light bulb just went off. I love that when that happens. And Kimberly says, Andy, you make me laugh. Well, that's just because I'm stupid. I make my wife and kids laugh all the time. So hopefully you're laughing with me, not at me so much, right? So let's just get a yes or no on this stuff here. How many understand a little bit the idea of this diagonal stuff, right? You got that right, Laron. A Utah man am I, for sure. Okay, so Williams says this is awesome, and Elias is getting it and loving it. Ono says I love it, understanding it. Okay, Now, if you don't, I've had one or two guys say, I'm not sure I'm quite getting it. Well, I didn't get it the first time either. So what you do? Well, we record all these, right? You go back in, you rewind, you listen to it again. It says, oh, okay, this time I get it. For me, it usually takes like 5 times before I get it. Some of you guys are getting it on the first time. So again, if we look at this option chain, here we're moving vertically up strikes, right? We have strike prices of 170, 180, 185, 190. We're moving vertically, right? But here, we're now going down to 274 days as opposed to May, June. So think about it. The strikes go which way? The strikes go, let's do it one more time just to make sure everyone gets it. Let's just say, 175, 180, 190, 200, 210. We can go, some options chains go up, some go down, 220, 230. So these are moving which direction? Vertical. The prices go up or down, don't they? Okay. But then we have this one where we say, well, we have these for May, and we have these for June and July and August, September, October, November, December, and January of 2021. So the price, the strike prices are on a chart vertically, but we always have time going where? Time is horizontal. Or horizon, right? Horizontal. And so one component's vertical. Well, if we pick to purchase the January 2021 175 is the one we buy. So let's put that in green. This is the one we buy, January 2020. And we decide to sell not the 175 horizontally, but we say, no, let's go down here and sell this one. We have a little bit of a vertical component here, don't we? And we have a bit of a horizontal component, so this is called a diagonal. And so you have different strikes in different months. So if you have different strikes in different months, they call that a diagonal spread. Or what I like to call it is I'm going for 2 for 2 for 2, a calendar spread. Right?
And Andy, it might be helpful also to think about going back to our definitions. What did we buy the right to do? What is our choice, and what is the promise we made? So in this case, if we think about the call option that we're buying a 2021 call option at the 175 strike. So by definition, I'm buying the choice. I own the choice to buy the stock for $175 per share at January 2021 expiration.
Yeah.
And then I've sold somebody else a little short-term option, a little rental, where if it were to get up to 190, if it were to get that high, then they would have the right to do something, but we would manage the trade if it got up to that level. We've given them, so we've sold them, or we've made a promise to sell at 190. We own the choice to buy it at 175, and that's where we have the vertical component, because we have the choice to buy at 175, and we've made a promise to sell at 190. So that's your vertical component, and really write these out just like we always do. We have the choice to buy at 175 at what date? January 2021. We make a promise to sell at 190 at what date? May 2020. So different time period, and that's where that diagonal comes in. They're different time periods. And so they're not vertical. If they were in the same month, these options, this would be called a vertical spread, because they'd be both call options in the same month. They're not. They're in different time periods. So that's that diagonal component.
So watch this. So check this out. I'm going to take a picture of this so I can make it a little smaller after I've written it. But let's start here. In a covered call, you would buy the stock, right? In a covered call, you would buy the stock. And you'd put the stock in your asset column, okay? What you've done here is you said, okay, I want the choice. And so notice which way the money goes. It's going to go here. And you paid $2,020 for this, right, to that guy. So this option called a leap goes right here. We'll put an L for leap because you bought it. You gave this guy some money and you now own this option. You have it. It's your possession. You have this. This is something you have, something you own. You gave him $2,000 for it. So for $2,000, you now have this leaps in your asset column, right? You have this leaps here. Okay, so how do you make, so this is almost the same if you think about it as owning the stock. Very, very close to owning the stock because you could buy it if you wanted to. You just haven't committed. So rather than spending $17,000 to own the stock, you're spending $2,000 to have the right to own the stock at the same price, $175. That's the first transaction. Now the second transaction looks like this, and I love your suggestion of drawing these out, Corey, is now you're going to be over here. We'll put you on this side, and now you're going to make a promise because that's how you make money. You're going to make a promise over here, and then over here, Joe Investor, Joe or Mary Investor, this time you're going to receive the money because you're making the promise right here. So let's put that in blue. So you're going to receive $300 right here. So that's in your income column, $300. And why do you get that money? Well, now since it's a call, this person has the choice to buy at, watch, 190, much different strike, $20 or $15, or what is that, $15 more? 190, yep. And you made a promise to what? Sell at 190. Now here's the question. You don't own the stock. So how in the heck, and I'm going to have you guys fill this in the question box, how in the heck can you promise someone to sell this stock at 190 if you don't own any shares of stock? How are you covered? How are you able to keep this promise? I mean, what if the stock, you don't even own the stock. If the stock goes to 190, how are you able to keep your promise now? Rashish has it. Right? Let's see who else has got it. Yep, Theo's got it. Yeah, that's exactly right, Kevin. Because if this guy comes and knocks on my door, if Joe over here comes over and knocks on my door and says, hey, Andy, hey, Andy, you promised to sell this to me at 190. I'll say, just a moment. I'll go to this guy and say, hey, you promised to sell it to me at 175. So I'll say, hey, Joe, just a moment, Joe. I'll be right with you. Just a moment. Yep, I did make you the promise to sell it to you one night. Just a moment. I'll go over here and I'll say, hey, you promised to sell it to me at 175. So I'll buy it at 175, right? That'll be my purchase price. And then I can come over here to you and say, oh, I'll sell it at 190 and I'll make myself $15 if I want to do it that way. If the price goes sideways and it doesn't hit 190, I just keep the $300. And if the price goes down, I just keep the $300 either way. And I can do this. Let's say that the month of May, this is 2021. This is just May of 2020. Let's say May of 2020 goes by and this just expires. What could I do in June? Perry Key says, I'm getting it. Yes, you are. I'm not having to borrow anything here, Mike. Look, I have the choice. I don't have to borrow because since I can knock on, let's just call this Mary right here. Why am I using a mouse instead of a pen? Let's say this is Mary right here. Since I can knock on Mary's door and buy this at 175 anytime I want to between now and January, that gives me the ability to promise Joe to sell it at 190. Since I can buy it at 175 anytime I want to, I can promise to sell it at 175, 180, 185, 190, 200, whatever I want, because it's if I own the stock. I have the power to own it anytime I want to, so it's as if I owned the stock. I won't get a dividend because I don't own it, but I can buy it anytime I want to. So since I have this choice to buy anytime I want to, I can sell or I can sell calls on it. So what's cool is I can make the same $300 here off a $2,000 investment that I could off of a $17,000 investment to own the stock. Do you guys like that one? Say yes if you do.
And that's an important point there, Andy, because who has more risk, the stockholder or the Leaps option holder? Well, holding something that has $17,000 of risk, which is owning the stock, is more risky than owning something that has $2,000. Now, it depends on how you look at risk, because other people would say, well, yeah, but the Leaps option has a better chance of losing all of its value. The stock's not going to go to zero. And so there's different components there, time value and so on. But just on a dollar basis, if I put $17,000 into the stock, that's more risky on a dollar basis than if I put $2,000 into the Leaps contract. Now, a couple of important points here in terms of the mechanics of this. People are asking, can I exercise my right to buy it at 175 early? Could I do that in May expiration?
We don't want to.
You could. And that's important. You could, and that's what makes it a covered call. We could knock on Mary's door and we could say, I want the stock. Here's why you don't want to do that.
Time value.
Why don't we want to do that? Time value. If I exercise my option, I'm turning it into stock, and I'm wasting all the remaining months of time value. So that it doesn't make sense from a mechanic standpoint for me to exercise that 2021 option early. Yes, I could notify my broker that I wanted to do it or whatever, but I wouldn't want to do that. Here's what we would actually do in terms of management. At expiration, remember the May option? Remember Andy's scenario about dangling?
Yes.
Why did we sell up at 190 in the first place? We sold up there because we're dangling, right? We're saying this isn't likely to get up to 190 at May expiration. In fact, if we go to the May options, we could look at the delta on the May options, and it'll give us a little sense of probability. So go to May, go back to May, and let's look at that 190. So the delta on that is
17% chance.
Okay, actually, I think it's 23. I think it's one up one notch.
We went 190. Yep, 23%.
Right, yep,
so 1 in 5. So there's 1 in 4.
Yeah. So if you say there's a 23% chance we're going to get to 190, that Microsoft could get there. The flip side of that is there's a 77% chance it won't. And here's what's important. Even if it gets to 190, where are you going to be at in this trade? Well, if it gets up to that level, you can buy back this promise. You can go into the market and buy it back, even if you had to take a little loss. Your Leaps contract, the right that you have to buy the stock at 175, will have gone up in value. And it will have gone up in value more if you're up there near 190 than what you've lost in buying back this option.
Yes.
So the mechanics of this, it'll take you some paper trading. And I know a lot of people are worried, well, I don't know every little aspect and every detail. And remember, it's practice trading. When you get in there and you actually start to perform these and you see how the stock moves, then you can start to say, oh, I see, as the stock's going higher, my Leaps option, it's going up nicely. And because I've dangled this one way out there, it's not changing much in value. It's a low delta option.
Let's talk about that.
There's some mechanics of it that really help out.
Let's talk about that. That's a good point, Corey. Let's just talk about this one up here, okay? Now watch this. If the stock gets up to 190, let's say it does, you can buy it at what? 175. So you can buy it at 175. So what's the intrinsic value of your option now? What's the intrinsic value of your option now?
Yeah, what's your equity, to use a real estate example?
That's right. Yeah, it's $15. Exactly, it's $15. So as it gets higher, this is going up $15. Plus, you still have a lot of what? Time left in this. You still have a lot of this $2,000 that you spent in time value. Remember, you spent $2,000 to do this. So you're very, very happy if this goes up. However, this guy, he doesn't have any time value left, right? It took time for this to go up. And here's another point. think about this. If you're nervous about that happening, you can go further out of the money. For example, maybe we say, nope, 200's the price. Well, you can still get $1.07, $1.08, we'll call it. Let's just call it $1. Well, think about that. If you're spending $2,000, you get $100, right? Divided by that $2,000 you spent to buy the option, that's 5% on your money in a month. And your chances of it hitting there are about 11%. About 11%, 1 out of 10. 90% of the time, you just take that money and go. Another way to look at this, and I'll draw one more picture that might be fun. Another way to look at this, in fact, let's put our pictures over here. Another way to look at this might be this, and this'll, most of you have already had the light bulb go off. We've only got one or two, and this'll fix it for the one or two. Let's say that here's you, and there's an apartment building, okay? A great big apartment building, okay, with lots of windows in it, right? Right here. Here's the big apartment building. And what you do is you lease a room in this apartment building. You lease a room for 6-month lease at, let's just call it $6,000, okay? $6,000. But then what you do for this other guy here, your tenant over here, what you do is you rent him that room, you sublease it. This is called a sublease sometimes. You rent this for $1,200 a month. So right here, your first month is only costing you $1,000, but it's costing him $1,200, so you're making $200 profit. And this is much more cheap. This is a lot cheaper, $6,000, getting $1,200 a month off $6,000 than if you buy the billion for $6 million, right? To buy the building, $6 million. So instead, lease this building, it gives you the right to have that room, then sublease it, and you get that difference right there. All you're doing is really buying time at wholesale in bulk, right? It's just this with buildings. You're buying the time in bulk, right? 6 months, and you're selling it by the month. So you're buying in bulk time and selling it right there. Really a cool idea how to make money. Here's a question I'm curious about this. Why don't I do this all the time? That's a good question. Why don't people do this all the time? Why don't people do iron condors all the time? You know, why don't they reduce their cost basis all the time? Do you know that some people don't even buy stock at all? In fact, some people don't even save money. You know, isn't that interesting? So yeah, it's a great question that I always have. Is, you know, I always bring it back to real estate. You know, what if all, you know, I think about this. What if I saw this on an infomercial late at night one time. A guy was on the infomercial saying, hey, come to my real estate seminar and I'll show you how to get rich. And I thought, okay, maybe I will. And the thing that made me want to go to that seminar is at the very end, the guy said this. He goes, you know, if all you ever did was buy one more house, I mean, you've bought one already for yourself. What if all you ever did was buy one more house and let the tenants pay it off, so when you were retired, you had an extra house and you had an extra income and a tenant in there, and you'd have the wealth that grew? You know, if all you ever did is buy one more house. And I thought to myself, you know, why don't I do that? Why don't I go out and buy some real estate? Why wouldn't I want to do that? And so I did. So here's a question. How many had no idea that all of these options, literal options, were available to you 6 weeks ago? How many had no idea 6 weeks ago that this stuff existed? Incredible, isn't it? It's like, and yet, if you go to Chicago, there is a CBOE, a Chicago Board of Option Exchange, and it's been there since probably 1972 or something like that. It's been there most of my life, and not quite 50 years, but it's been there a long, long time. And off you go. So, pretty amazing. Yeah, David's doing the math here. And of course, David, that's only if it goes up or sideways. If it goes down, you're losing money in this leap for sure. So, there's risk to manage. It's not magic, but it sure is more exciting than a 401k. That's for sure. Yeah. But yeah, your calculations are correct in what you just shared with me. That math is correct. So that's pretty cool stuff. Is that the exchange they showed in Ferris Bueller's Day Off? It could have been. They were in Chicago. It could have been.
I think that one was actually the CME, which is the Chicago Mercantile Exchange, which is for commodities, but very similar.
See, I was too focused on Ferris's girlfriend because that's the 80s. I mean, I was in high school when that happened, so I was just I had the hots for like Molly Ringwald back then, and all that. The Breakfast Club people, right? That's awesome. So, yeah, Sloan, totally, I'd forgotten her name. Sloan, she had it going on, right? That's awesome. It's like someone saying, come on now, focus, Andy.
Come along now.
That is awesome. So that is called the calendar spread, and you'll see this in Mentor Club. What is the way to get good at this? Once again, this is always one answer everyone can get right every single week. How do you get good at this? How do you get good? Yeah, you just practice. And what if I screw it up in a paper trading account? What's my risk in a paper trading account? Yeah. Brian asks a really good question. Would I have an exit strategy of this? Yeah. If this stock, right now it's at the money at 175, about 173. So we're doing this out of the money. And I could actually, you want to learn your deltas and stuff like this. If I want to get closer to actually like owning the stock, I could actually buy this one, spend a little bit more money. I could buy the 155. That's going to act more like having a stock. But I would definitely have an exit strategy if it started going down. And here's what's cool. If this, if I buy this one and it starts going down, that really sucks. But guess what else is going down even faster? The one that I sold. So even if I bought the stock and the stock goes down, this 300 hedges it a little bit. Well, if I buy this leap and the leap starts going down, this 300 hedges a little bit. But I would definitely buy the stock with an idea that I had a line in the sand that if it went down, I would sell my leap back, roll down, whatever I want to do. And of course, I could buy that back for almost nothing and have it still get that money in my pocket. So the way you do is you'd want to treat it the same way you would as if you own the stock. If I own the stock, I probably have a stop loss if it goes down. Well, if I own the leaps, I probably have a stop loss if it goes down. So definitely, actually, I'd have a stop loss if it goes down. So this is great stuff, right? This is great stuff. And that's really would be the downside to this strategy. There's two downsides to it. Number one, the stock can fall just as if you own stock. That's a downside. And number two, you're capping your gain at 190, right? You're giving up some upside at 190, which you're also doing in the covered call. But you can do this in an IRA as well. It's that.
Yeah, and that's it.
That's conservative. You can do that in an IRA as well. This is a trade you can do.
That's an important point in terms of our cost basis, our max risk. Our max risk, you would think, well, we bought the leaps for 2020, so we have 2020 at risk. Well, we reduce that cost basis by $300 right out of the gate. So we actually have 1720 cost or max risk in this trade from now to May. At May expiration, if we sell another option, we're reducing our cost again. And then we sell another in June, we're reducing that cost. So think about your cost basis that way. What would be the ideal scenario in this trade? Your outlook for this trade that we've built here is neutral to bullish.
Moderately bullish.
You don't want a huge downside move. You want this stock to work its way to 190. And here's the thing. Remember, we're dangling that carrot. If it goes up to 190 or thereabouts, but this short-term option expires or we buy it back for cheap, we can dangle again. Now we get to move it up to maybe 220. And then imagine it goes up towards that level, and then we move it up to 250. In other words, we could keep dangling higher and higher. And if this stock is really bullish and keeps climbing over time, then your leaps contract is just going to be making a ton of money. So there's a there's a directional component to this trade. It's not just pure time decay. There's risk and reward in that leaps option toward how that stock is moving. So we don't want the big downside move. We want it to be working its way higher, and that would be your outlook. So good point on that. This is a neutral to bullish outlook.
Marvin asks a really important question. Marvin Jean, he says, what's a stop loss do? Well, and you might not be this far in your 4 pillars yet, but in your risk management section of your 4 pillars and in the cash flow section, both, I believe, is every time we buy a stock, and it would be the same with buying this leap, is we want to have 3 things. We say, well, we want an entry point where we buy, it's going to be a strike of 175. We believe that the stock will have a target maybe of 185. Notice we sold above the target at 190. And then an exit. And maybe I say, you know what, if this goes to 170, I'm out, right? So now I have $5. If this were stock, I have $5 of risk, and I have $10 of reward, and I have another $300 reward if I sell that call above there. And notice that my target was moderately bullish. I dangled it just outside where I thought it could go. And if you notice on Microsoft, we didn't do this. We should have done this, Corey, but Microsoft has some resistance up top. So if we really did the 4 pillars and...
guess where that resistance is?
I'm just saying sometimes you get lucky.
190.
I'm just saying sometimes you get lucky. I don't know. We'll take a look here, but we'll look at that. Look where the resistance is. It's at 190. So you get lucky once in a while. So there's the second pillar of technical analysis. You know what? Probably goes up there, hits its head, and then it struggles because that's where it was before. And notice that it had come back even before coronavirus. It had dropped down and had some troubles. This is coronavirus down here. So we've got a good line in the sand where we dangle that carrot out there at 190 for a month. Say, yeah, you probably hit your head on it and don't get it. So nice, Corey. Maybe did you see that and put 190 in my head subconsciously or something? Did you see that?
There may have been. I may have known about 190.
You doing your 4 pillars better than me. I'll tell you what, Corey's the man. That's why we have you here, right? Right. Yeah, I like the Forrest Gump thing, Michael. That's cool. Michael Wheeler's got the Forrest Gump one-liner going on. So, Marino says, could you delta hedge this? Absolutely. You can always delta hedge something, right? Always delta hedging. The question is, Vera asked this question, is the market too risky right now? Well, that depends on your level of your education. For my mom, I think it is. But for me, I've been participating heavily in this market with tremendous enthusiasm. So that's been fun. So let's do a couple of questions right here. We promised some Q&A, and this always gets away. I always tell people, I go, never do Q&A because it gets away from you. But you guys are nice to us, so it won't get away from us. You guys are too nice. So let's just fire off a bunch of questions. I'll do a page worth or so. We'll do like 20 or whatever is bunch. So do I do butterfly trades? Yep, I do. And this is really cool. Someone says, I want to go through this again. Yep, we'll record it. We'll post it. It'll be awesome. And I know that for me, it's been helpful when I've had, I wish in organic chemistry, that the teacher, I went in there and just took notes as fast as I could. I wish that had been on video because there'd have been a lot of times I would have gone back and watched that lecture again and paused it and thought about it. And then once I got it, moved on, right? So our technology in our day and age is a lot better than what we had when I was in college. I struggled in college, man. Okay, still getting a few things. Yeah, we might be able to take a look at some of these. Okay, looks like we're getting most of them. Want to play the cash flow game? Absolutely, we play the cash flow game. Okay, let's take a picture here. And I think these are good questions. Let me see if I can make this any bigger and get the whole question because my software only lets me go so wide into the questions. So some of these, you guys ask these long ones and I can't squeeze them all in. So you got to have it like in 10, you got to Twitter this, 48 characters or whatever it is, right? Okay, so let's start with this one. This is a good one. And this is going to be a ton of questions, man. This is a lot of them. So this will work right here. Okay, and and again, if you have another question beyond what we can get to, email us or whatever you need to. Corey's awesome with his team and in helping us with all that stuff. So let's open the clipboard. Holy cow, look at all those questions. Let's move all this stuff off of here so we have a nice clean board. A lot of cool pictures this time. Okay, question number 1. Can we delta hedge if things start going down? The answer is always yes. You can delta hedge any trade anytime you want. Delta hedging is not just for iron condors, it's for anything you want. In the current market, is this too risky right now? I don't think so. I think it's basically about your ability to manage a trade and to adjust trades. Now, it's never too risky to practice on paper because, on paper, the only problem with paper is when it works out. Like, be honest, this gold trade worked out. All the trades we did in this Quick Start Live, they all worked out. 100% of them did. And so you're like, well, gee, I wish I'd have done that for real, right? Because this is virtual earnings, and I get to go take a virtual vacation or buy a virtual Ferrari or whatever. But, really take that to heart, that if you really paper trade, it'll be okay. And then when you get your confidence up, think about it. Is the market too risky right now? Well, if I know how to buy put options, I don't care because I can lock in where I can buy and sell. If I understand these options well, then that gives me more control of that market. Does that make sense? Give me a yes if that does. Does that make sense, you guys? That if you really understand these options, then you get promises and guarantees of where you can buy or sell. You can lock down this risk, right? You can lock this market down. So for me, I'm not scared to trade right now. Not at all. I got trades on right now for sure. What's the best option to start with? Well, that's kind of an advice question. We don't give advice, but I would say this on it. I think one of the best options to start with is to decide what stock you want to buy and what price you want to buy it at and say, you know what? I was going to buy 100 shares of XYZ stock anyway. Maybe I'll sell a put and promise to buy it. And that way you're just getting paid to do something you're going to do anyway. There's no more risk in doing that than if you bought the stock. You're missing out on some upside possibly by owning it if you'd have just bought it. But that's a nice one to start with. And I think a covered call, if you owned a stock and said, you know what, if someone gave me an offer I couldn't refuse at this price, I would take it anyway, so why not get paid to take it? So I think a basic cash covered put and a basic covered call would be some great starting points for cash flow from options, okay? Quarterly earnings reports create an unknown for me. And what's interesting is in the ultimate options class, we have a trade we have called a short strangle. So, for example, let's say I bring up Facebook for a minute. Okay, this is a really good question about earnings reports. Is earnings report something I control? Do I have control or more control or less control on an earnings report? More control or less? What do you think? So, if I look at risk. And I go to the fourth pillar in the 4 pillars of investing, and I say, here's just a basic rule of risk and the relationship to control. Is if control goes down, then risk goes up. But if control goes up, risk goes down. So when I look at an earnings, what most people do is they play Vegas, right? They try to guess. Well, I'll bet Home Depot did really well, or I'll bet Kruger did well, or I'll bet Costco did well, and they try to guess if the earnings report is going to be good or bad. So what I will do is look at things that are more predictable with earnings and do different types of trades called volatility crushes, because I don't know whether that earnings report is going to be positive or negative. So if I bring up Facebook here, and let's just open this up and do an implied volatility graph right here. I'll add that to select and apply it. Is if I look at Facebook, and let's just take these 4 earnings dates, and I'll show you something that's really interesting about their personality. Is there's an earnings date, there's an earnings date, there's an earnings date, and there's an earnings date. And if I go down here, I see a volatility crush. I go down here, I see a volatility crush. I go down here, I see a volatility crash. I go down here, I see a volatility crash. See that? So for me, that's not guaranteed, but that's much more predictable And notice that here on the chart, it gapped up, so that must have been good news. Here it has a big up bullish candle, probably about there, so that was good news. But here it gapped down, so that must have been bad news. So this was good news and this was bad news. But guess what? The crush was the same on whether it was good or bad. So I like to play the crush rather than try to guess up or down. I'll play the crush. And this is a little bit more involved, but direction's tough to figure out, this happy or sad. But the volatility crush, a little bit more predictable in my opinion. So that's kind of a cool lesson on earnings, is a short strangle. We didn't cover that here, but I don't wait for quarterly earnings. In fact, I might pull out or turn a covered call into a caller, because over earnings is where I might buy a put just for that day and protect myself if I don't want to get out. For paper trading, the market is not risky. That is true. Would I do a simulated trade of a stock that is low and likely to go up, but, oh man. Well, let's see if I can find Christina here and see if I can get the rest of that question. Where is Christina at 11:08? So Christina, let's see if I can finish this. Okay. Would you please do a simulated trade of a stock that is low and likely to go up by January? Well, I could try, but here's what's interesting, is I don't know what direction the market's going to go by January. We have coronavirus. We have, a tremendous economic challenge in our world. I think the market may have found a bottom. It may not have found a bottom. So, my answer there is I don't know. But this is what I would say, Christina, that might be helpful. Is do you guys remember how Corey and I were trading KHC? And we started trading KHC, and we use this in the 4 pillars a lot, so I think this might be helpful, is let's go 2 years of this. And you'll notice that Corey and I started trading KHC here. And you'll notice that the stock has not really gone up in the year we've been trading it. And to tell you the truth, I didn't know whether the stock would go up or down. I think long term it will. I don't know by January. I think in 30 years it will go up because I think we'll have inflation. And I think the prices of stocks will take more dollars to buy them because of inflation. I think all the products that Kraft sells will get more expensive because of inflation. But by January, I don't know. But here's what's cool. What I do know about this trade is I can sell options for premium. Does this help a little bit? Does this help? So I'm not really good at knowing whether the stock is going to go up, sideways, or down. But if you'll notice, the trades that I've showed you, particularly the cash covered put, if you remember, the very first thing we taught you is that we want to be in trades where we really don't care if it goes up, down, or sideways very far. We're just going to dangle premium outside. And the other thing you'll notice, if you remember, is what is easier, to pick a direction or a range. So that I do all day long. For example, watch this. Let's put on a probability cone. I think you'll like this, Christina, because this is a great question by you. Let's put on what's called a probability cone, probability expiry cone. Let's just add that, apply that here. And let's go out to, I don't know how long it'll let me go out, Corey. This will let me go out to September anyway. I'm not really good at guessing directions, but I'll tell you what, by September, I don't think Kraft Heinz is likely to be at 70, and I don't think it's likely to be at 10. So I might find some strategies that help me make money inside of that zone. Does that help, Christina? That's really cool, isn't it? That the way we trade, wouldn't it be, how many like the idea of being able to trade without having to know the direction from now on? Say, I'm in on that, if you like that idea. Say, I'm in on that idea. Yeah, there you go. Christina, great question, and I can tell by your comment, you get it, right? Is that Corey and I, what we're teaching you is really not about direction, but rather ranges and premium and other cool stuff we do rather than just going there. This gives hope starting out with minimal capital. I agree. I think that right now, the way the market is, if you want to participate in a company like Amazon.com, that's going to be tough for a beginner because they're not going to have a lot of money to do that with. So that's good. What's a good way to pick a leap stock? Who can answer that question for me? If I wanted to find a good stock or a good leap, because it's kind of the same, right? Kind of the same. How would you go about finding? Who can tell me what tools could you use? Oh, look how beautiful this is. This is a beautiful thing. Look at the answer to this question. I'm going to bring this up. You guys are just, my heart gets warm. I love it. Look at this, Corey. That's how, right there. Yeah, fundamentals and technicals. In other words, you use your 4 pillars. How many of you, let me ask this, how many of you are in the coaching program? Just say I am if you're in. Let me just see. Who's in the coaching? So David, you had yours up first. David and Areta Ono, John. A lot of you guys are in, okay? So you guys, has that helped you with the answer to that question of, you've probably gotten far enough into your coaching now where you've at least done some searches. Has that been helpful? Absolutely, Kimberly says. Way helpful, right? So this is really a big deal. A couple are saying, oh, you're starting in May. Some of you are on the waiting list, so good job, Gene. Okay, there's a waiting list. Email us if you want to get on the waiting list, and we can help that. Oh, you've also gone through, Theo says, I've been going through older Quick Start labs, which are awesome. Yeah, they are. David's starting in May. So part of the coaching program, what helps you is we help you find these, and we show you the criteria and the searches we run to find those. And the same ones in the 4 pillars of investing, so that's good. Now, this is really a good question by Dan Prescott. Go ahead.
One thing real quick for as far as the coaching, that was a great question. You think about putting those pieces together. We take you through the 4 pillars in the coaching program and say, fundamentals, let's do some fundamental work, and then let's find what we're going to trade. Technicals, let's identify the key levels, and it'll tell us where we're going to trade. What levels we're going to use. Cash flow, what strategy do we want to use? And then risk management, managing that trade. So the coaching program is designed to take you through that and really build kind of a trading plan so that as you're paper trading, you have structure and you have guidance as far as why would I choose this strategy over another? Why would I do this? And really give you that guidance that a lot of people need and want. So really great question there.
If you remember, and this is in all of you have the 4 pillars. So remember pillar 1, fundamental analysis, jog your memory just a little bit, is, we taught you a little bit about earnings and growth. And then we said, you can start practicing with basic criteria. So for a bearish stock, we had EV over EBITDA, enterprise value over EBITDA greater than 20 bearish, EV over EBITDA greater than 10 bullish, PEG ratios. And then if you remember, we had the searches, and this is what we do in the coaching program too. We just do it with you and help you do it. Is I can go to anything really. I can go to Yahoo Finance, for example. Yahoo Finance, because remember, Benjamin Graham says it's basically earnings and growth, right? Which is exactly what this is. Earnings, enterprise value over EBITDA is an earnings metric, and then you have growth. Let me see if I can sign into this here. I don't know if it'll let me, but oh hell, it's asking me for password. I don't know what my password is. Asking me for a password. Allow. Is it going to make me find my phone? Next. Password. Oh, I don't have my phone with me. It's making me provide a password. But anyway, we set you up. Remember in Yahoo, this is what it looks like when I'm logged in on my phone with me to do my text back stuff. But you'll notice here I have, look, large cap stuff, greater than 10. I have EV over EBITDA, and I'm my PEG ratio. So I have these same criteria right here on this for bullish fundamentals. I hit go, and it gives me a whole list of stuff to find. And look that's how I found Kraft Heinz, actually, is there it was. And so I clicked on it, and lo and behold, a year later, I'm trading Kraft Heinz. So hopefully that helps a little bit. Let's see. Is there a difference between rolling down and selling? Not really. When you roll down, you sell where you are. And so picture it like this. Picture rolling down is getting divorced and finding a new spouse, right? She says, my wife should roll down. I shouldn't tell her. I've never taught my wife exit strategy because I'm afraid she would use it immediately. And she would be able to roll up, let me tell you, very quickly, roll up and out. So when we go rolling down, Dan, think about this. This is kind of a cool idea, is we had these strikes. Do you remember this? Where we had 175 and 180 and 185 and 190 and 195 and maybe 170 and 165 and 160, right? So if this was your position, let's say, right here, rolling down means you would sell or get out. We'll just say exit this position, and maybe you take a position lower. So that would be rolling down. Well, if this is May, you could also roll out. So let's say this is August. Maybe you exit this position and you take the same position in August. So this would be rolling down, but this would be rolling out. So you have this idea of negative or a diagonal and all that type of stuff. So the answer is, yeah, you're selling your current position or exiting, buying it back. You're exiting one position and then taking another. Do I do butterfly trades? Yes, I do. Let's see, I'm going to have to listen again. Good job, Sean, because that's why we record them. We don't record them for decoration. We don't record them just to put them in there. So that's awesome. You're taking advantage of that. Put diagonals are possible as well. Yep, you can do it with puts. I don't do much Forex trading. The short answer to this question is yes. In the Mentor Club, we will do some Forex trading when we feel that it's relevant, when there's good opportunities there. And with futures, we do those all the time as a hedge, especially E-mini futures as a hedge. So, yeah, stay tuned for that in the Mentor Club. Let's just see. Oh, this isn't Mentor Club. This is a live account. It's not simulated, because simulated was giving us grief. But the answer is yes. We do cover some of that stuff. How do I choose a trading portfolio? Some of in the past went bust. This is a great question, Jelena. The way I do it is a lot like when I shop for a car. When I shop for a car, I could buy a Ford, a Chevy. The more important thing is knowing how to drive, right? If I don't know how to drive, it doesn't matter what car I get, I'm in trouble. If I know how to drive, then it's kind of my preference. So the way I do it is trial and error. I'll try one. I have accounts with Options Express. I have one with E-Trade. I have one with Interactive Brokers that Corey and I trade together. I have this one. I've got a bunch. And so I've become familiar with a lot of different platforms. They all have graphs, and they all have option chains, and they all have the same information. Just learning where to click for them, right? Little different platform. But the best way to choose a platform is to try them out, just like test driving a car. Pick one and test drive it and see if you like it. Is there a difference between rolling down and selling? Do we do that one twice? I don't know. We covered that. How far back do I check the chart? That's awesome question. Awesome question. As far back as I need to. If I see a stock that's we're not going to have anything in a bullish trend indefinitely here. But let's pretend, that I'm up here in Amazon at this all-time high. Well, gee, I don't see any resistance. Let's go back a little bit and see if I can find any, right? So I might go back, max available on it. And I say, no previous resistance. So how would I find new resistance? Well, the way I would find new resistance here, now that I know that it's at new highs, maybe I start here and maybe I draw a trend line and I say, okay, what's the trend line? Let's see if I can get me a marker here. I say, all right, what's the trend line? And I draw that there. I say, oh my gosh, it's already broken out of its trend line. So then what I do is I say, well, how far does it usually move in a breakout? How far does it usually move in a breakout? So it's probably right here now. I take the same distance, this far from the top to the bottom, or a Fibonacci retracement. That's a great question. I go back as far as I can to find resistance. If I don't, I start using trend lines. And if I can't find a trend line that's broken through all that, then I look at what's its average surge look like. What has its personality been in the past? That's a great question. Let's do this trade. Okay, let's do this trade. Let's go to Microsoft, and let's go here, and let's go to May, and let's just sell a. What do you think, Corey? What's this? What would it be called here? Let's just sell a calendar.
Diagonal, probably.
Here's a calendar right here.
Or you can tweak it.
Yep. So right here, I know the one I want to buy is way out in January 21st, and I want to buy the 170 call. Is it going to let me tweak this?
I think it was.
This is a horizontal.
I think it was 175.
Yeah, it's not going to let me.
You might have to click it to diagonal. Yeah.
I'm just going to go custom.
Or go custom.
So I'm going to go the 175 right here, and then I'm going to sell the May 15th 190. Was it 190 we decided? And notice that's actually a debit trade because I have to buy the stock. And what's really weird is when you look at the risk profile, it's going to make this tent shape type thing. And the reason it makes the tent shape like thing is because I have two different months in here. But that's it.
So remember that the total cost there around $1,750 or whatnot. That's the $20 we're paying for the Leaps option
minus the
$3 that we're bringing in for the short-term option. So should be right around 17-ish bucks.
And I'm going to go the midpoint of 1750, and if I wanted to do this, I'd hit confirm and send, and done deal. So that's how you would do it. Awesome stuff. Pretty simple. Notice this. Oh, I don't want to log off. Notice this. This is a good question in doing this trade. And let me get your feedback on this. How many are starting to realize that there's only 6 things you could do? Buy stock, sell stock, buy calls, sell calls, buy puts, sell puts. But within that, there's a lot of different combinations of those, right? Yeah, that's it. Yeah, someone says, remember, you're in a live account. Yeah, that's why I didn't send it in. I got right to it. I should have put it right over the confirm and send button and freaked everyone out, right? That would have been awesome, right? Yeah, so that's cool. And that's not $1,750 each month. That's just one time. That's just one time. And then after that, what I would do is, see, this one would expire, right? This 15th of May of 20 would expire. I would still own the January one. I just sell another call, sell another call, sell another call. So that would be awesome. How does earnings affect timing in a Leap? It's just like a stock. It's just like a stock. It's going to go up or down. It's the same as a stock. I'd like to learn a little bit about rolling, closing, buying back. If you really want to get take the Ultimate Options class, David, man, it is so money. We had a lot of people sign up for that last week, and I don't have the sign that I put up. I'd have to build a new one. I could put that up again. We're going to keep that special going to the end of the week. I'll have to look up the email where the link is, but I'll do that before we go. I'll have Corey talk about something while I find it. What kind of spreads do we look for? Minimum return. Now, Christopher, this is a very popular question. What type of spreads? And it's a very difficult question because that's kind of like asking me, hey, Andy, what do you look for in a girl? Well, I'm married right now, so I can tell you red hair, 5'10", physically, mentally, very smart, emotionally, very strong, sense of humor. Got to have one to live with me, right? She stays in shape. I don't need that, but that's her. I guess I look for that. She obviously didn't. And so, what are you looking for minimum return? Now, that's me. Depending on the amount of money you have and knowledge you have, it depends. In other words, it's not a one-size-fits-all. Who can appreciate that investing is not one-size-fits-all? It's just not. If so, we just hire a computer to do this for everybody, right? You just computer, off you go, and win or lose, right? But I would say this to give you, that's that's the proper, correct answer, but it's not one people like to hear because they want to be told what to do. And I get that because I want to be told what to do. So I'll tell you this, on a spread, I like about 90% probability in my spread, which means 10% of the time I'm going to have to adjust. So I'm going to be happy here. I'm going to be sad here. Not really sad, but this takes work. And I'm going to want to get about 5% in a month. So this is my probability, and this is my return. Now, why? Why? Well, there's nothing magic about those numbers. The biggest reason why I like those is because I am inherently lazy. And I only want to have to do work 10% of the time, because this has to be adjusted, and that means I have to do work. People that day trade, they would do 80-20 or 50-50 and just do the work. Noah Davidson loves to do this work. Me, I'm lazy. So if you're asking, for me, I don't know what it'd be for you, but if you say, what spreads do Andy look for? That's what I look for. What it should be for you, well, how much time do you want to spend? Do you like adjusting? Do you like delta hedging? Do you have any comments on this, Corey? Because this is a very popular, question, that we get a lot, and it really is up to you. I don't know if that helps, Christopher.
Yeah, and there's just different strategies, or we have different percentage returns that we look for and so forth. And that's what's really good about Ultimate Options is we try to lay that out. Like, for example, if we were selling a covered call on a stock, what type of premium do you want? Well, we usually like to get 1% of the stock's value. That amount is kind of in the ballpark of what we're looking for. It's still dangling the carrot, but we get enough premium to make it worthwhile. And so there's not a one-size-fits-all for every trader, and there's also not a one-size-fits-all for every trading strategy. I think you did a good job of explaining on credit spreads. Yeah, we want to be highly probable when we sell a credit spread, because really we're just trying to put on a trade that's highly likely to work and then managing it when we need to, which should be a lesser amount of the time. So,
what I said. Can this investment go in this event for buying time go down value? Yeah, Max. If the stock goes down, the leap would go down, just like a regular call, no question. What if you're called at 90? Two things you could do. And you could be called at 90. You could wind up short that stock and keep your leap. You could exercise your leap. But generally, what would happen is you would not exercise that option. You would probably just buy back that call. And the loss in buying back your call would be swallowed up, hopefully, in the gain of your option. So that's what I would do. I would exit the short call before that happened. If you write puts to buy shares and the price drops below strike price, well, that's a good question, but think of it this way. You really want to know why you're buying that put in the first place, right? You really want to know why you're buying that put in the first place. So look, let's say the stock is at $100 and this is the stock and your put strike is at 95, okay? Well, what if you buy the stock and it goes down below 95 to 90? Well, then you're out, let's see, if it goes down 100 and it goes down 90, you're out $10, okay? Here, if it goes down below, you're out 5, right? So the idea when you buy a put is if it goes below the strike, right, then you are taking that risk anyway. Now, if you buy the stock and you say, I want to have an entry and I want to have an exit here, and I want to have a target here, you can do the same thing. You say, you know what, I'm willing to risk this, but if it gets down here, I'm going to exit the trade. You can do the same thing if it bothers you. Generally, though, when I'm going to sell a put, that's to acquire the stock. I want to own that stock long term. I want to ride out the ups and downs generally, but that's a good question. Could I do one trade with the leap? We just did that Microsoft one, so that's good. Why a stop loss instead of delta hedging? Knowledge. People that don't know how to delta hedge usually have to stop loss. People that know how to delta hedge take their choice. The reason I like to delta hedge is if that stock pays a dividend, I'd rather own it than get rid of it. And I might be willing to ride some stuff out. The other reason, because of a stop, is if I'm in an iron condor that looks like this, right? And I kind of get in that nasty spot in the risk graph, like right around in here. if I get out, I lose for sure, right? I lose for sure. If I delta hedge, it has a chance to go down and I'm protected, but if it comes back up, I can stop out and I can still win. So it increases my chances of winning by 50% if I delta hedge instead of stop loss. But most people don't know how to delta hedge, so they're stuck with stop loss only. How am I going to remember all this stuff? I don't know. That's a good question. For me, I just started paper trading and stuck with it. I remember when I was playing basketball for Rick Majerus, I really struggled because I didn't play in high school. I was tall and lerpy and uncoordinated, and I could foul, so they put me on the team. But I didn't know anything about screens. So when he's saying, hey, you got to call out the V-back on the help side and drop that guy into trash as you attack penetration umbrella into that outside the paint stop, I asked the same question. Like, how am I going to remember all these plays? We got fist up, we got fist down, we got fist side, we got fist away, we got wheel, we got motion, we got double staggered, flare screens, cross picks, we got flex action on the baseline, we got pick the picker on the other side of the flex action. How am I going to remember all this stuff? And here's the key, I think. Is what you have, and this is a fun lesson for coaches, is you have a process and you have a result. It is really important. And the result, most people say, I'd like more money and I'd like more time, I'd like more freedom, I'd like health, whatever. And this is all happy stuff, right? This is all smile, happy stuff. The question I have is, with the process, for some people, that is also happy stuff. And for some people, it's stat stuff. And I found that for money, I really enjoy the process of doing all this by repetition. This is really a good question right here of how am I going to remember all this stuff, because this is a quick start lab, right? It's quick. It's a quick start. It's accelerated. It's a huge amount of information in a month, massive information, accurate information, but nonetheless a lot. And so I would say if you've enjoyed these quick start labs and you enjoy the epiphanies, you enjoy this, then you stick with Mentor Club for sure, where you'll get this reviewed again and again and again and again. It's a lot like going to Spain in a foreign country. I'm like, how am I going to remember all these words and phrases? How am I going to remember all this? Stick with it. Stick with it. So hopefully that's a good pep talk, and you say, you know what? That's awesome. I am going to stick with it. That's how you remember it. About this trade, when you are 30-40 from January 21st, how do you exit? If I want to get out of any trade that I want to get out of, right, I can get into a trade. I'm not in a simulated account here, but I can right click on this, and anytime I want to get into one, I can get into one, and I can right click and get out of it either way. You'll notice here's the opposite trade that I can get into or out of. I can't show you in this one because it's not a demo account. We're not in this trade, but I guess I could. I don't know. I better not. I don't like fooling around with real money. But that's how you exit. You right click and do the opposite trade. Do you have access to this info for life? Yeah, as long as I'm around or you're around, one of the two, whichever lasts longer, whichever dies first. I don't know. But yeah, you get this for life, the information. Now I will say this, I was not going to do quick start labs this year. We were going to phase it out. And the reason is we started quick start labs out of demand, really. And after that, it was so much so fast. I said, Corey, we didn't really want to do it because it was a lot of work and we're lazy. Well, Corey's not, I am. And I said, Corey, let's do it right. Let's do this. Let's do Ultimate Options. And it took us over a year to build it. And so you'll notice that a lot of the same slides I've used to teach this here, Ultimate Options slides, because it's longer, it's more in depth, it's all that. And I said, I'm going to phase this out. Well, we have people ask for it every year, and every year I say no, and then I cave and we do it. So generally, the pattern has been is that usually in February, March-ish, Corey and I do another round of these, and people have seemed to have liked coming. Some of you have been coming to these for years. Some of you are new. But that's been our practice. So I guess the question is, would you like us to keep doing yearly quick start labs? It is interesting. Some of you said it. You've gone back to the old ones, right? You've gone back to the old ones, and it's interesting, isn't it? Because the environment's so different, right? It's such a different trading environment. So the way we've always done it is once you're in, I've always promised to leave the old ones up, and you can go back and review this forever. I've never promised to do it every year. I just cave and do. I've just caved. And the truth of the matter is, if you put me on a lie detector test and say, hey, Andy, do you enjoy doing these? And if I say no, I would be lying. It would go off because I do enjoy them. I enjoy being with you guys.
They are a lot of fun.
It isn't something I would want to do, every day because I'm a businessman and I have my time with my family and all that. But I'll tell you, too much of anything gets fatiguing. But I love being with the students, and I love being with Corey, and I learned so much with Corey. So that's pretty cool stuff.
Yeah, and I do have to admit, every year we're kind of like, do we want to do those again? And then we get in it, and when they're coming to an end like this, I start to go, oh, I'm going to miss this.
A little melancholy. Yeah, you're a pushover, Corey.
A little sadness.
I'm going to try and bring up the paper trade account again and see if they've got that all worked out. That doesn't happen very often for the paper trade account to be screwed up like they had it screwed up. But the short answer is, yeah, you get this information for life. We don't put a end on your ability to access.
I think we might have figured out what it was with the paper trading.
Yeah?
It might have been calculating the whole covered call in the bid ask. So it might have been saying if you buy this option and sell that one, it might have been giving a full combo trade if you buy the stock and that. So, but
that's
anyway.
Bizarre. Well, I'm going to try and bring it back up because I saw the EOG trade here, and we ought to come check on that because that might be in the money. It might have gone up. We might be in trouble. We might have to hedge that. We'll have to look at it. Any tips on selling covered calls in this volatile market? A, you could not sell the covered calls, or B, sell them further out of the money because here's the deal. More volatility means what? What does it mean? More premium, right? So the more volatile, the higher the VIX is, the further out of the money you go. If you don't want to give up the stock, then don't write a covered call on it, right? If you don't want to give it up, then don't write a covered call on it. Take your dividend or write it way out of the money where they give you an offer you can't refuse. Okay, how's it going with the gold trade? Well, I don't know. Let's look. GLD. Whoop, that's GLS. I need GLD. Let's see how it's going. Let's pull this off. Well, it's going very, very well. We have a 99.78% chance of expiration. Here's a standard deviation. This expires tomorrow, and in reality, do you see how we're at 60? If we're at $60.55, if we want to exit today. So if you want to take your money and give up the other $2 that you made on that, that's your prerogative. Me, I'm just going to let this expire. So that's how that worked. EOG, 99.85% chance of expiring. You're supposed to make $27, and it's they won't give you that because they're going to make you let it expire because they're not going to sell it to you for zero. And someone said, hey, how do I get out of a trade, right? Well, I can click on in fact, I could highlight both of these and click on them, and I can sell both, sell one, sell the other. See, I create a closing order. And if I create that closing order, it's not going to give me zero. I'm going to have to put in like 1 penny, like boop, like that. And then I can buy it back for a penny. But I'm not going to because it's going to expire worthless. So those are the two trades. Did you guys enjoy both of those? Like the worst thing you can do is just make money that easily in your first times. Because then you're like, oh, I've got this figured out, right? I've got this figured out, right? So it's, the horror. Someone says. Yeah, so really easy stuff on GLD and EOG. So there's those two trades. Can you look at WFC? We can certainly look at it. Well, let's take them in order. Do I have an ultimate option discount? I do. I gave it out last week. Give me a minute, and at the end I'll put it up again. I'll find it, and I'll put it up and leave it up there for like 5 minutes after we're done. But I don't have it with me right now. I have to look up the email with the site and the who can remember what the code is? Isn't it Ultimate? Isn't the code Ultimate? I think it is. In the risk pillar, you cover stop losses. Do I prefer those to the trailing loss? You know what? I like a good stop loss. And to tell you the truth, for me personally, I like to hedge a lot. But I like either one. I mean, it depends. If you really feel the thing's going to take off, you can put a trailing stop on it. I don't have to babysit as much. But I like to adjust my stops. Either one is fine. We did the EOG trade. Now we can look at WFC. So WFC. Wells Fargo. I have a lot of bank accounts there. Okay, so down here, this is what, this really isn't a low base. It's really kind of a volatile mess down here, but you can see that the financials, they've certainly been hurt. And if I wanted to make money on this right here, you can see that it's got some pretty good support in here. Let's probably bring in some more history and see where the next old support is, if we could. So it looks like it's been a while since that's been there. Let's just go monthly. Maybe that'll give me a better view. So look at this. It's hitting some support in over here as well. It's got some room. Boy, it was a bargain back in the crash days. So certainly, very similar looking to this. This would be, if this were me and I was looking at this right here, I would probably say, do I want to own this stock? And if I do, I would sell some puts to buy it even lower. And I'm sure with this volatility, those puts are very good. You could also do maybe a bull put spread and do puts down here and see if it bounces. A lot of things you could do with this, depending on what you wanted to do. Me, I'd probably buy some, being that cheap. And I'd write some puts to acquire it is how I'd do it. I'd also look at the sector, though. Where's my XLF? I'd also look at the sector. Let's get this in here. This is important to see how it's performing, because the banks have been beat up, right? The banks have been beat up. How come that won't let me grab that? Let's try again. Come on. Corey, it won't let me grab that and bring that out. So let's just go XLF. So XLF is the financials, and see, it's been beat up as well. So it's not like this is, if you looked up U.S. Bank, and a lot of the banks have beat up. Look at this right here, how they got killed in 2008. So the banks, they're not out of the woods yet. Maybe you call it dollar cost average into it a little bit. But yeah, compared to the sector, it's par for the course. Par for the course. So that's a little bit on WFC.
And probably a little relative weakness in Wells Fargo. So it might tell you that, if Wells Fargo is one of the weaker components, that's not usually a good sign technically. There's something specific in the fundamentals maybe. So then you could go, well, maybe I want to look at JP Morgan or something like that, JPM, or, find something that's held up relatively well that might have a little better strength in the financial sector.
What's the most options trades on one stock you've had act at the same time? Here's 4, and this is not an iron condor, as you can see. These are all puts. Here's 4 of them. I've had 6, 7 sometimes, because you're adjusting and adjusting and adjusting. When you look at Square, let's see where Square is. Do we still have any Square in here? If you look at Square, we've only got 2, but see, that's risk-free now, so we really don't have to adjust it at all. That one's risk-free. So, the more Microsoft, we've got 3 on. This is a butterfly. Somebody was asking about the butterfly stuff. That way, if it moves up in here, we make some money. If we don't, we lose $80. We'll take it. Nice. If it does hit that, we win the lottery. But if it doesn't, it only costs us $80. So you can have a lot. Could you show building it in Thinkorswim? We just did that on the Microsoft, so that's good. Can we take future quick start labs? Andra, would you like to? If we do, you're invited, and I think we'll probably cave and do it again. Want us to play the cash flow game? I do want you to play the cash flow game. It's the best way to get the context of investing. Have you gents? Hey, I'm a gent. I love that. William, thank you. I haven't been called a gent in a long time. I'm a gentleman. Have you gents ever used the education report from Thinkorswim? I never have. These guys, I'll give you a little bit of their history. Way back, they had a seminar division called Invest Tools, and they were purchased by Thinkorswim. I shouldn't say it. I've gone to some swim lessons, and it's not bad. The challenge I've had is they make it kind of complicated sometimes, but I haven't done a lot with theirs, but it's not too bad. If you already know what you're doing, it helps. But any education is good. Of course, we like our education better, but I never, ever dissuade anyone from wanting to get education. Can you include paper trades so we can see how we did that on Microsoft? It's like drinking fire hydrant, but it's tasty. I love that. That's a great one. I'm going to remember that, but it's tasty. Will I do some more classes? We want to hang out longer with you. You know, once in a while, what I think I might do, Tyler, is how about this? Maybe we do a round table, and, you know, maybe a couple months down the road, we check in with everybody and just invite everyone to a round table. That might be fun. Do something like that. How many more Quick Start Labs? This is the last one, but you've got, probably, if there's 8 per year, and we've done how many years, Corey? 5 now? Or 6? 5 or 6? So there's
someone was saying 6 years. So
6 times 8 is 48. So there's 48 quick starts. So there's 48. So I don't know. This is the 8th one in this one, but you might have 42 more to go. In paper trading, am I trading with actual people? No, there's not someone on the other side of the order. That's an interesting question. No one's ever asked that before. Nope, it's just simulated. They pretend as if there is someone. It's hard to move from paper to real trading. Yes. When can you do that? That's an awesome question. First of all, it is hard. So let me kind of show you an idea here. And this is you guys' questions are money. Okay, watch. A lot of people might think of it this way, where it goes like this, where here we have real, and here we have paper. Right? And we go along and we learn, all of a sudden, boom, now I'm ready to go real. How about this idea right here? Why don't we go like this? Something like this, maybe something like this, like here, and maybe we go like that. In fact, you know what? Maybe we always have a little bit of paper. Maybe we do it that way because I still paper trade. We always have a little paper. And we go paper like this, and then maybe we add one real trade, right? We start one, and we make it kind of a graduation right here where we do one trade and graduate. Does that make sense? Instead of going cold turkey from 100% paper, maybe just start with one real trade. And then the other thing I would say is when you start that is make your position size small. And when should you feel comfortable in doing that? Well, I'll tell you when I would. Watch this. I'll tell you when I'd feel comfortable, at least myself, going from paper to real, is when I do my risk analysis. I've done the 4 pillars of investing. I have 3 things the delta could do, right? And if it's an options, I have some things the theta could do and the vega could do. And there's also some rho there, but these 3 will probably do you okay. And if I get in a stock where I'm okay with this and I'm okay with this, and I'm maybe not thrilled with that, but I can live with it, now I'm ready. This is always going to go down. This could go up or down or stay the same. But as long as I look at the scenarios and I say, okay, if it does this, if it does this, if it does this, will I be okay? One of the things we do, let me bring this up. This is an ultimate options thing. Do I have that? Let's just do the covered calls one. Is one of the things you do to get to this point is you can really tell where things are likely to go and draw lines in the sand. So when we do the risk management right here, right, then what I do is I say, okay, what if what if the price falls? What if the price rises? What if it goes stagnant? What if time runs out, right? Which goes this way. What if volatility falls? What if it rises? So those are the same ones I just wrote, right? So every time we do the way we do this is pretty cool in the ultimate options, is I go, okay, what if the price falls? And here is my risk management toolbox right here, right? So, okay, if the price falls, Well, maybe I sell the stock and I sell it at X a price. And I say, okay, if the stock went down and I lost this much money, would I be okay with that? And if the answer is yes, I'm ready to trade it. Because now I have control over my trade. I have control over my outcome. So hopefully that's helpful, is once you look at those different possibilities and you're comfortable with all of them, and if you're not, make your position size smaller, right? If you're not, make your position size smaller. So that's a great question. Hopefully that's helpful. How do you hedge against volatility? That's a great, great question. You understand that volatility is not going to hurt you in a short option as much as delta is. Remember the three monsters? We had the big delta monster and the small volatility monster, the small time monster. You deal with volatility because at the end of the day, this is the one that's really going to hurt you. So delta hedging is a great way to do that. If you have little money to start with, what can be done to increase value and liquidity? Well, one of the things is diversify across asset classes and learn to raise capital, right? But the other thing is I like the idea of starting off with a paper account, because you'll be surprised, Janet. Once a person learns, I said this last week, once a person learns how to do this on paper, it's very difficult to buy doodads. Because when you do come into a little bit of money, like, well, I go out and buy this or that or the other, but I can also put it in the market because now I know what to do with it. So when you have little money to start with, certainly paper trade the heck out of it and learn it, and off you go. I almost missed this webinar. Glad I didn't. Thank you, Lan. Thank you so much. Can we see how it will close? Yeah, we were just doing that one, so we're in good shape. So great questions by the group. Whoo! Corey, that was like 50 questions. That was fast. That was good. Great job, awesome. You guys. Great job. Oh, someone wrote in. Give us the ultimate thing again. Hang on. Corey, talk about this gold trade for a minute.
I put those in the chat box.
Oh, did you?
Put in, there's a coaching link and there's an ultimate options class with the discount code ultimate. So open up your chat box and you've got the links if you want to sign up for coaching or the ultimate options.
That's fantastic. I'll try to take a screen capture of this. Hang on a second. Look at this right here. I just got this from my buddy Mike Dennison. So I'll just cut and paste this out of the email. That'll be quick enough. Give me a minute, and I'll put it up here for those that can find it in the chat.
Okay. I'm telling you right now, they're not going to let you off the hook. You see the messages coming in. You promised them a video. David mentioned it.
Oh, my gosh, that sucks. I forgot all about that. Hang on. Facebook. Let me find Corey. We'll just go to Corey's freaking Facebook page, and I'll find it there. How far down do I have to scroll to get to that, dude? I'll just go to videos. Hang on. Photos. Corey's photos. Albums. Let's see. Videos. Holy moly, Corey. How many videos do you freaking have, man? Oh, here we go. Here we go. Hang on. There he is, ladies and gentlemen. Now, hang on. Let me see if I can do this. Hang on. Let's see. No, that's not going to work. We got to have volume in this. How do I make it go so we can hear?
You have to understand that this is from the 90s, and this is on a VHS tape. Okay, so you're going to need to fast forward past all this junk.
No, man, we got to see it. Ladies and gentlemen, oh, look at these guys coming out on the floor here. 49 to 50. 49 to 50. Who should we give the ball to, boys? Who wants to take the big shot out of this timeout right here?
I think this is when we played bad defense and they actually scored. You might have to skip through.
Oh, we got to skip through this. Oh, now we're down 8 seconds.
There you go.
Now, hang on. Set the table for us, Corey. What game is this?
So this is our championship game, my senior year in high school.
Senior year championship. Okay, here we go.
I am by far the smallest guy on the court.
All right, here we go. Oh, the suspense is killing me. You know, no one here has watched basketball for a month. Where are you? You're number 12, aren't you? Is this you?
I'm 21 right there, yeah.
This is you right here. Oh, look at this. Here he goes. He's going to, look at that fill cut. Shot fake, penetration, yes. Oh! Corey Halliday, ladies and gentlemen. Oh! Listen to the guy making the call. Corey Halliday! Amazing! That is so money. All right, let's see everybody's comments on that. Hang on, I got to take this down. That probably just like destroyed all of our sound and everything else and all that.
Yeah, who knows?
Let's see. Oh, and the crowd goes up. People are like, you got fans here, man. Teresa said guards are so important. Well, they never pass. Look at that. William says we got a basketball Jones, man. Oh, that is awesome.
Trust me, that is my only basketball.
No, your life has just gotten better from there, man. It's just gotten better from there. You know, I should show your wife as Harley Quinn is what I should show. Then they know you really got it made.
You know, so. Andy went on to play for a big time college school. For whatever reason, the colleges weren't interested in a guy that was, 5'8" and 130 pounds or something.
I'm just telling you right now that I was like the worst basketball player ever. Okay, it was pretty bad. I don't even think I have any pictures of me as a Ute. If you Google it far enough, I don't think the internet was invented back then. Probably it's pretty bad. So anyway, that was like 100 pounds ago for me. So we'll stay away from that stuff. It was pretty bad. Pretty bad stuff. So anyway, all right. Well, great job, you guys. Just a fantastic session. We'll do a couple of round tables, right? And get going. Oh, Larry says he's been stalking me. Couldn't find anything. I wouldn't doubt it. I think I scored like 2 points my whole career. I played at a JC first, and it was kind of bad, but it was pretty good times though with my friends and all that type of stuff. Pretty good stuff. Corey, anything to take us home and round us out here?
Yeah, I mean, I would just say, first of all, thank you all. We know that this is a trying time in life, and stay healthy, stay focused on what's really important in life. We have absolutely thoroughly enjoyed every minute with all of you. So keep after it. You're going to do great things. And thanks everyone for the great comments.
For sure, guys. Again, I can't, I get emotional because I know how this can change lives over the long haul and over the long term. So we just appreciate you guys. We love you, and send us emails. Check out Ultimate Options. I'll put that back up there so you can have that. And we'll see you guys soon. Okay. Thanks much, everybody. Great job. Wonderful job.
Goodbye, everyone.